Okay, we're going to go ahead and get started. We have a lot of people joining in. We're going to have almost 50 people on this webinar, and people are still kind of trickling in. So I'm going to go ahead and get started. Hello, everyone. My name is Ara Ogorian. Thank you for joining the webinar today. This goes to show how much of an important topic it is, given the number of people we have on here today. So again, my name is Ara Ogorian. I am not only a CFP, but I'm also a CPA. I'm the founder of ACap Asset Management and ACap Accounting Services. We provide wealth management and tax services with a specific niche for healthcare professionals. I want to point out this webinar is being recorded, and we will have it available to view online on our website and also on our social media platforms, including all the questions that you ask. Please ask any questions you have in the question box on the webinar, and I will try to get to them towards the end. All right, so without further ado, let's go ahead and jump right into it. Now, unless you've had the flu for the past month, and I know some people have, and I've been completely cut off from the news, President Donald Trump signed H.R. 1, also known as the Tax Cuts and Jobs Act of 2017, into law on December 21st, 2017. That's the biggest tax overhaul in the past 30 years since the Reagan tax cuts. It's important to note that the individual tax cuts expire in 2025, and they do this to comply with budget rules and also so that tax cuts don't cost more than 1.5 trillion. But the corporate tax cuts, on the other hand, are permanent. So with that being said, let's go and talk about the roadmap. Now, this webinar will be split up into two different sections. We're going to talk about the individual and personal taxes, and we're also going to talk very briefly about the corporate taxes. Specifically, we're going to talk about the pass-through entities such as LLCs and S corporations. Now, as I was putting this presentation together, I realized that the corporate tax portion was way too complicated to go into too much detail today. So what I decided to do was I'm going to go over it very briefly, and then I'm going to have a separate webinar that's only going to focus on the corporate taxation side, because the calculations related to the pass-through entities are pretty complicated and require a lot more time than probably the 20 or 30 minutes that we're going to allocate today. The tax law itself is over 1,000 pages long, and we're obviously not going to cover all of the changes, but what I am going to go over is what I think are going to have the biggest impact on our clients. So anything that I feel that's going to have the biggest impact on our clients and people that are participating in this webinar, those are the types of things that we're going to cover today. Again, if you have questions, please put them in the comment box or in the question box. And then at the end of the webinar, I'm going to answer as much questions as I can. And if I don't get to your question, what I'm going to do is we're going to post this webinar on our blog, and we'll answer all the questions that come through. So even if we don't answer your question now, we will answer all the questions at the end, okay, when we post it. So please go ahead and post your questions. The biggest change in the tax law is the individual mandate of the Affordable Care Act, also known as Obamacare. This has been repealed. The individual mandate required or forced individuals to buy health insurance, or they had to pay a fee if they didn't. Now, it's important to note that this actually starts in 2019, not in 2018. So taxpayers without health insurance in 2017 and 2018 are still subject to a penalty. Now, this was one of the biggest key components that President Donald Trump wanted to put into the Tax Act, and it was able to finally get into it in its current form. But I also want to point out that it does not go into effect until 2019. But this was a huge, huge change, something that he ran on his platform when he was running for president, and he followed through with this commitment to repeal what is known as Obamacare, or the Affordable Care Act. The other biggest change that have taken place are the widening of the tax brackets and the lowering of the tax rates. So what I've done here is I've shown the tax brackets for 2017 and 2018, and I've focused only on the single and the married filing jointly, because rarely does it make sense for someone to do married filing separately. And although it does make sense sometimes, I didn't include it in this presentation just to make sure that we didn't run out of time. As you can see, one of the most notable changes is the top tax bracket drops down from 39.6 to 37, but also the amount of income that you can make within those tax brackets has also increased. So basically now you're able to make more money at the lower tax brackets, and also more money at the lower tax brackets, but also people who are in the higher tax brackets, which is why this has been coined as a tax break for the wealthy. People who are in the higher tax brackets get a significant tax benefit because they're able to make a lot more. We'll see for the married as well. They're able to make a lot more at a much lower rate at 37%. Okay. The other biggest changes that has been getting a lot of press is the personal exemption and the standard deduction. In 2017, taxpayers are entitled to an exemption of $4,050 for themselves and their dependents. So if someone is married with no kids in 2017, their personal exemption would be $8,100. And the exemption is phased out if their AGI, their adjustable gross income, is above a certain threshold. In 2018, that personal exemption is completely eliminated. Excuse me as I drink a little bit of water. The standard deduction, on the other hand, has taken a different form. The standard deduction allows taxpayers to take the greater of their itemized deductions or the standard deduction. Now, itemized deductions are those deductions that go on an individual's Schedule A of their tax return. And they include things such as mortgage interest, property taxes that are paid, state and local income taxes, donations that are made, medical expenses subject to a certain limit. If all those expenses are greater than the standard deduction that a person gets, then a person can take that itemized deduction. But if the standard deduction is greater, then it's more beneficial for the person to take the standard deduction. Taxpayers without a home usually use that standard deduction because it provides them with a higher deduction than they would have had if they did the itemized, unless they do a lot of charitable donations or they have a lot of medical expenses. So in 2017, the standard deduction if you were single was $6,350. And in 2018, that doubles to $12,000. And if you're married filing jointly, same thing, it's $12,700, and it more than doubles to $24,000, which is huge. So if you're someone who maybe are older, have your house paid off, especially in a state like California, and your property taxes are low, and in 2017 you were not getting the itemized deduction because your interest payments, you didn't have interest payments and your property taxes are so low. Now you're able to get that higher standard deduction because it's essentially doubled since then. Let's see. All right. Moving on to the next section. Again, please, if you've got questions, go ahead and post them in there and we will, I'll get to them at the end. Okay, going on to the next slide. State and local income taxes. This is a big change to taxpayers in high income states such as California and New York. In 2017, property taxes, state and local property taxes were deductible up to a limit if you were a high income earner, subject to the alternative minimum tax. In 2018, now this is a really big change, the deduction is limited to $10,000 for your state and local income taxes, including property taxes total. This is why some people prepaid their property taxes in 2017 for 2018 if they were allowed to do so, because they were allowed to get that deduction in 2017 because that deduction no longer exists in 2018. Now, I want to point out that property taxes still remain fully deductible on rental property. So if you have a rental property and you pay property taxes, those are still fully deductible. They're not subject to this $10,000 limit. Okay, another big change is home mortgage interest deduction. In 2017, prior to the tax law, interest on up to $1 million of indebtedness was deductible, mortgage interest was deductible on your tax return. In 2018, because of the tax law, now interest is only deductible up to $750,000 of indebtedness. But if you bought your home before December 15, 2017, you're essentially grandfathered in, meaning you can still take up to that $1 million of interest deduction. And also, if you were to refinance your property, you're still able to take that deduction. So it doesn't mean that you're locked into a particular rate and you can no longer refinance because you're bought that property before December 15th. You can refinance is okay. Another big change is home equity line of credit. So historically, interest was deductible on up to $100,000 of debt on home equity line of credit. That is no longer the case. In 2018, there's no deductibility of home equity line of credit interest, and there's no grandfathering. So meaning if you have an existing home equity line of credit in place, it may be beneficial for you to pay that off or refinance or do something else, because you may not be getting, or you will not be receiving that interest deduction for 2018 going forward. I'm just going to look at some of the questions coming in. Again, please post your questions and we'll get to them all towards the end. Okay. The next one is the alternative minimum tax. Now, initially, both the House and the Senate versions of the bill, if you recall, the House passed the version, then the Senate passed the version, then they came together and they tried to negotiate the terms between the two. Now, both of their versions repealed the AMT, the alternative minimum tax. But for some reason, and it had everybody excited when they decided to repeal it, but for some reason it snuck back into the final bill. But luckily, the exemption is much higher than it was in 2017. So for example, for a single person, the AMT exemption was $54,300. Now in 2018, that's jumped up to $70,300. And for married filing jointly, it used to be $84,500. Now it's over $109,000. So your income has to be a lot higher before you're subject to AMT, which is a nice refreshing change because the AMT was hitting a lot more people than it was initially intended to do. Here is another positive for the tax bill, and it's related to 529 plans. So prior to the tax change, 529 plans could only be used for college expenses. So they could only be used for room and board, tuition, books, things like that. But the tax law changed, this new tax law changed, so now you can also use 529 plans to pay for K through 12 education up to $10,000 a year. This is huge for someone who wants to pay for, whether if it's private school or secondary school or some other education for their kids, and they want to be able to use their 529 plans they've got saved up. Please continue to have your questions come in, and we'll go ahead and get to them at the end, I promise. Okay, now the next one is some miscellaneous items. Miscellaneous items, one of them is alimony payments. This is also a really big change, although it's very confusing how they've got this worded. In 2017, prior to the tax change, alimony payments were deductible by the payer and they were taxable to the recipient. Now going forward, alimony payments are no longer tax deductible by the payer, and they're, no longer taxable to the recipient. But it only applies to divorces and separations effective after December 31st, 2018. But but even that has some very weird nuances to it based on when the divorce decree occurred and a lot of other variations. So for this one, if hopefully you're not going through a divorce or a separation, but if you are, make sure you communicate with your the family law attorney to make sure that that alimony is deductible if you're the one paying it, and if you were the one receiving it, hopefully you're going to structure it so you're not getting taxed on it. Moving expenses in 2017, moving expenses were deductible if you were moving for a new job that was at least 50 miles away. This was very beneficial for especially residents, medical residents, or fellows who are moving to a different state or moving over 50 miles because they weren't able to deduct those expenses. Unfortunately, in 2018, that's no longer the case. Moving expenses are not deductible. Also, casualty losses. Prior to the tax law change, casualty losses exceeding $100 and 10% of AGI were deductible. That is no longer the case unless the president, him or herself, declares a casualty, and at that point, it will be deemed deductible. The last one is something that applies to many of our clients, although not to much of a degree in the past few years because of how the market's been doing. But Roth recharacterizations in the past were allowed, and in 2018, they are no longer allowed. For those who don't know what a Roth recharacterization is, it's basically if you took a regular IRA and you convert it to a Roth IRA and you pay tax on it, you can, in the past, redo that. You can say, well, I don't want to do that Roth conversion and pay the tax on it. I want to convert it back to a regular IRA. It was beneficial if you had a tax liability that was greater than what you're expecting, and then you could redo it, but that's unfortunately no longer the case. Again, because the market's been so well, most people did not do a Roth recharacterization. It mostly applied when the market was declining and most people are recharacterizing their Roths. Okay. Going on to the next page. All right, so for the business entity types, I'm not going to, now we're moving on to the business section. I'm not going to go over the taxes for the C corporations because it applies to very few individuals. But what I am going to do is define what a pass-through entity is because it applies to so many different people and many of our clients. So what I've done here is I've given some examples of what a pass-through entity is and also briefly what a non-pass-through entity is. So let's go over some of the different entity structures. First, we have a sole proprietor, which is a pass-through entity. That is someone who's got, let's say, a W-2 job, maybe may not have a W-2 job, and maybe sells some jewelry at night from their home. Any income they receive from that sole proprietor position would be reported on their 1040 through what's known as a Schedule C. And then any income they would have would flow through to their 1040 and then pay tax on that at their regular tax rate. That's very important to note, their regular tax rate. An S corporation is a separate entity, it's a corporation, but there's no federal taxation of that S corporation. Typically, this would be a firm like a CPA firm or a law firm, or it could be a general corporation such as a mechanic shop or a flower shop. The corporation itself would file what is known as an 1120S, and then that corporation files that return. The net profit of that corporation then flows through to the person's individual tax return, and then again, they would pay tax at their regular tax rate. Okay, that net profit, they would pay tax at the regular tax rate. Next one is partnerships or LLCs. These are very common for people who buy apartment buildings or rental real estate. They put them in an LLC. The LLC provides them with legal protection, but it also provides them with tax advantages because that money flows through to their personal tax return. The LLC files what's known as a 1065. The net profit from that LLC flows through their personal tax return, and then the individual pays tax at their regular tax rate. So what is not a pass-through entity, and what we're not going to cover are C corporations. A C corporation is like an Apple or a Google. Those corporations report income, they pay tax on that income, and then from the net profit after they've paid tax, they might pay a dividend to the shareholder. Maybe you or someone you know may receive dividends from their stock holdings they have. Those dividends are also taxed. So as you can see, there's a double taxation feature here with a C corporation that does not apply with the pass-through entities. So now that we know what a pass-through entity is, let's go ahead and see what the new tax change is for the business entities. Again, I'm going to do just very briefly, going to go over the tax deductions. So pass-through entities now get a 20% deduction on net qualified business income. This is really, really big news for all businesses, whether you are not C corporations, but whether you're a professional corporation or a general corporation, this 20% deduction is really big. Now, professional service corporations such as doctors, lawyers, CPAs cannot take the 20% deduction if their income exceeds the phase-out limits, which are outlined in the next bullet point. So if the phase-out limit, if an individual is a professional service corporation and their income is above 157,500, then they are not allowed to take that 20% deduction. Or if they're married and their income is above 350,000, then they're not able to take that 20% deduction. If their income is below that, then they're able to take that 20% deduction. But if they are a personal service corporation, as I mentioned earlier, then there are some rules that have to be followed. So as you can see, the deduction is not a very straightforward 20% deduction. It's based on a number of other calculations, which we will dive deeper into when we do a webinar strictly on corporations. If there's a non-professional corporation and the taxable income is greater than the phase-out limits, then the deduction calculation becomes really complicated, because what happens then is you take the greater of the 20% deduction versus W-2 income, and also depreciable assets that you might have in the business. Right? Okay, so we obviously covered a lot of information on the individual side, very briefly on the business side. And as I mentioned, I am going to have a separate webinar exclusively for the business entities, mostly the pass-through entities. But right now I'm going to open up some questions. I'm going to go ahead and start looking at some of these questions that we have already. Okay, the first one is, what is AMT? AMT is the alternative minimum tax. And the alternative minimum tax is a parallel tax that applies to individuals whose income exceeds a certain amount. And if you recall, there was exemption limits earlier. I'll get to those exemption limits in a second. So in 2017, if someone was married filing jointly and their income was above that 84.5, they would be subject to the AMT, and they would have to pay a tax in addition to their regular income tax. So it's a great question, what is the AMT? Because in 2017 and prior years, it affected a lot of people, many people who did not intend it to affect. But in 2018 going forward, hopefully with these higher exemption amounts, it will hit far fewer people. Okay, let's go to the next question. Can you explain the 20% deduction on the business taxes? Like I said, I'm going to go over the business taxation component of it in a separate webinar. For the time being, just assume that if your net profit from your business is, if your income is under that 157.5 for single or 315,000 if you're married, then you're able to take that 20% deduction. But if your income is above that, there's some nuances to it. It's unclear yet in the IRS how they're going to actually put this on a tax return. It's going to go on page 2 of the tax return, but actually where it's going to go is still really unclear. But soon, hopefully, the IRS is going to have some clarification on how this is going to get reported on the tax return. Also, how they're going to identify personal service corporations, because right now it could be based on SIC codes, which are codes that define what a profession a corporation is in. Okay, let's go to the next question. Okay, have there been any major changes to the 401k limits? Great question. There have been, although not within this rule. So there was, in 2018, the 401k limit went from 18,000 in 2017 to 18,500 in 2018. Unfortunately, the IRA amounts did not change, but the 401k amounts did change. So that's a big change that that went into consideration. Let's see, we got another question regarding moving expenses. Okay, let's go back to moving expenses. Okay, so the moving expenses, like I said, historically, if you were moving from one city to another, if it was at least 50 miles away and it was for a new job, you were able to deduct some of your moving expenses. And they were on the front page of your tax return. It was an immediate deduction. It was great for someone who was moving for a new job. Unfortunately, that is no longer the case. So that deduction is completely eliminated. And that's unfortunate, especially for, like I said, residents and fellows who had to move and maybe were not getting reimbursed for those moving expenses. Okay, let's go to the next question. College savings plans. There was a question about college savings plans. So if a grandparent, yes, so the question is whether a grandparent can also take advantage of the 529 plan benefits. Absolutely. So if you're a grandparent, and most of the time grandparents do set up 529 plans for their grandchildren, if you are a grandparent setting up a 529 plan, you can also use that money for K through 12 education up to $10,000 a year. So that's a great question, and it does also apply for grandparents or anyone else who's setting up a 529 plan for their kids. Okay, let's do one more question, and then the remaining questions, we're going to go ahead and post them all on the website with the webinar, the recorded webinar. Okay, the question was on a home mortgage interest. So just to clarify, the question is just to clarify for homes purchased before December 15. Okay, so the question is, if someone bought a home before December 15, 2017, are they grandfathered in? Yes. And if they refinance, are they grandfathered in? And the answer is still yes. So if you bought your home, let's say in October of 2017, and 3 years later, you refinance your home and it's over and you have $800,000 of indebtedness, you're still able to deduct that entire $800,000 of indebtedness interest because you're grandfathered in before December 15th. Now, keep in mind, these rules change and revert back to their 2017 laws in 2026. So in 2026, it's back to the $1 million limit again, unless Congress extends these tax cuts. Okay, that's at the 30-minute mark, and I wanted to keep the presentation at 30 minutes. I do have a few questions that I have not got to. I apologize, but we are going to answer all of the questions and post them on our website and also on our social media platforms. I want to thank you all for participating. Please send me feedback if you want to see a particular type of topic in a webinar. The next one is going to cover the corporation taxation, and we're also going to have another webinar that's upcoming that's going to focus on insurance. It's going to cover insurance on homeowners and property casualty. Thank you again for participating, and hope you have a great day.